All right, so I'm traveling, so I don't have my normal, sitting spot, but it's fine. Um, so before we get a little too far into, the different type of accounts that you can set up and what may benefit you better, we should probably go over um, the concept of interest rates, right? So there are three different types of rates that you need to understand. Two of them deal with deposit accounts, and then one of them deals with lending and or loans that you may or may not be taking out in the future. Um, so all of these rates are based off of a prime rate that is set by the Fed. So you've probably heard of prime rates and how they're set um, after every meeting, which they typically have, I think, around 6 meetings per year. But it doesn't always mean that it changes. It just depends on how the economy is doing, etc. But the first rate that you should definitely know about is the dividend rate. So that is the specified rate that you typically hear of a lot with deposit accounts when you are looking at what rates they will help to accrue per month for you, and then obviously throughout the year. And then you will hear about a annual percentage yield. So both of those rates are typically associated with deposit accounts, but it depends on the institution on how that works. So, the reason why I say it depends on the institution is each institution does it differently. You want to kind of find the one that will most definitely give you not only the highest rate possible and available, but the one that allows it to compound. So, the difference is with a dividend rate, the rate that is given to you, that is not including any compounding interest throughout the term, however long that term may be, or the indefinite term. So most of these rates are readily available to change if there isn't a type of contract that is signed, such as a certificate of deposit, where it says you will get this rate for an extended amount of time. So, uh, for the example, again, it depends on the institution. If you gain, let's say, $10 on the amount of interest within this next month, typically, if the yield and the dividend rate are not different, so your yield will typically be higher, your amount of interest that you gain will go somewhere. It will typically go into another share account or a different type of account that does not allow the compounding that goes forward. So when you talk about the interest yield or annual percentage yield, that allows, so let's say you make $10 on your first month, that interest will actually stay with whatever product or deposit account that you're in. And then the next month when you gain, it might gain, instead of $10, it might gain $12. So your interest yield will almost always be higher. So the obviously the time that your dividend rate and your yield is going to be exactly the same is when they do take out that dividend rate or that amount of interest that you accrue, and they put it into a different share account. So then you move on to having your annual percentage rate. So your annual percentage rate is based off of the lending that you end up doing. So whether it's a personal loan, a credit card, a auto loan, house loan, whatever, that's how much interest you end up accruing throughout the year. Now, typically, from experience, and again, it really changes through most institutions, but it really just depends on kind of um, what type of product that you do have. Now, most credit cards will have a monthly yield, or a monthly amount of interest that it accrues throughout through I guess throughout the 30 days to 31 days, etc. So whenever the end of the month is, or whenever the end of the accrual period is. So most other lending products, though, will have a daily rate. So anytime you hear somebody request for a 10-day payoff or a 15-day payoff, 30-day payoff, doesn't matter. That pretty much says that the loan or the product that you have has a daily rate that it accrues every single day. So, depending on what your interest rate is and depending on the amount that you have borrowed, that will kind of determine the daily rate for you. So, the the annual percentage rate that you end up getting on a loan will differ, and the amount of gravity that it has to your loan will depend on the amount that you do borrow and the rate that you get. And I will actually go much more in depth with that when we talk about the credit portion of this conversation.